Today we are going to learn how you can become wealthy through the power of compounding, and we will also explore how bankers, brokers and insurance agents are drowning you in the swamp of poverty. We'll look at the things they and all successful people know that allow them to get richer, while middle class or poor people stay exactly where they are. But before that, let me tell you a story. A man goes to visit a city. While wandering around, he goes to a beach where people show him expensive yachts. The people there tell him, this one belongs to the local bankers, this one belongs to the brokers, and this one belongs to the insurance agents. After walking around for a while, the man innocently asks, that's all fine, but where are the customers' yachts? Hearing this, the people there start laughing and say, oh you fool, customers don't have yachts because they never earned enough money to become wealthy enough to buy one. I am sharing this story from the book, Where Are the Customers' Yachts? This book is 90 years old, but the same things happen in the investment industry today as they did back then, because there are certain secrets of this industry that bankers, brokers and insurance agents do not tell us middle class people. As a result, they keep getting rich themselves, while we middle class people remain poor. I have divided this video into 3 parts. In the first part, we will understand the concept of compounding. In the second part, we will see how these bankers, brokers and insurance agents are making you poor. In the third part, we will see how a normal salaried person can become wealthy using compounding. Compounding means compound interest. You probably studied this in childhood, but you likely didn't understand it then. When you invest your money, the interest you earn on it also earns interest, and this system continues. If you didn't understand this, you will understand it through this example. Suppose you and your friend both invested 100,000 rupees, on which you both receive a 15% return every year. At the end of the year, both of you will get a return of 15,000. Your friend withdraws that 15,000 return, but you leave it invested and let it grow. The next year, both of you again get a 15% return. Your friend withdraws the 15,000 again, but this time you won't get just 15,000, you will get 17,250 rupees. Now your question will be, why? Because you let the interest grow and earned 15% interest on that too. Meaning, the 15,000 return you got in the first year, which you didn't withdraw, is now also earning a 15% return. So the return on the 100,000 you invested is 15,000 rupees, and the 15% return on the 15,000 you didn't withdraw is 2,250 rupees. So the total is 17,250 rupees. The calculation might seem simple to you so far. Now let's fast forward a bit. And suppose 10 years pass in this process. Your friend keeps withdrawing his money every year like always, but you keep your returns right there. After 10 years, how much will your 15% return give you? Your 15,000, while compounding, has gone above 55,000, and that too in just a 10-year time period. Your investment has become more than 400,000. Your friend is still receiving only a 15,000 return. Both of you invested the same amount of money, 100,000 each. But why did this difference occur? It is because your friend is living his life by simple interest, and you are living your life by compound interest. Now, you all might say that we aren't so crazy as to waste that 15,000, we do the same thing too, but you don't actually do it. Let me explain with an example. Suppose you bought shares worth 100,000 and got a 15% return on them, which is 15,000. You quickly withdraw that money and enjoy it. You don't let your money compound so that the money brings more money, and that money brings even more money, allowing you to earn money while you sleep. Now some of you will have the question that the stock market goes up and down daily, so how will compounding be used here? In theory, the compounding graph looks like it's going straight up, but in reality the stock market fluctuates a lot, so how is compounding used in this? Let me explain with an example. I am showing you an index. Look at the one-day chart of this index and see how much it is fluctuating. But when you look at it for a long period, like 5 years or a lifetime, it will only go up. I want to explain to you that when you invest in a good company for the long term, no matter how much it goes up or down daily, in the long term it will go up. That is why I say that even if you invest in an index fund, you can build a very large amount in the long term. There is a biggest enemy in the world of investment called inflation. For those who don't know, let me tell you that inflation means rising prices. In 1995, the price of 1 kilogram of pulses was 1 rupee and 25 paise. But today inflation has increased so much that the price of that same 1 kilogram of pulses today in 2026 is 70 to 80 rupees. If you calculate the inflation of this, it will come out to be between 9% and 10%. Therefore, if you only save, your money will have no value in the future. What you can buy with that money today, you won't be able to buy with that money in the future. And that is why I say, do not invest in places where you get a return of less than 10% in the long term. I know many elders who, in the pursuit of safe investment, invested their money in schemes where they used to get a pension of 10,000, which covered their expenses for the whole year. But today, that same money doesn't even last them for 3 months. Those who fall for safe and fixed returns now will suffer the same fate. Now we come to the second part, how those who provide investment services, meaning these brokers, bankers and insurance agents, hide the secret of becoming wealthy from us. There are two sides to this investment industry. The first side is the buy side. They profit only when you keep your money with them or buy their policies, such as banks and insurance agents. On the other side is the sell side, meaning the brokers. They profit when you make as many transactions as possible. That is, when you buy and sell shares. First, let's talk about the buy side. I will explain this with an example. I'll describe a policy to you and you tell me how it sounds. You have to deposit 10,000 every month for 6 years, and after 20 years I will give you 25 lakhs. Tell me in the comments what you think of this policy and whether you would invest in it. Now, let me show you the truth of this scheme. In this scheme, you are receiving a 7.5% compounded interest rate. In the future, the value of this investment will be even lower because, as we've learned, actual inflation is between 9% and 10%. Right now, it looks like 25 lakhs to you, but what you can buy with that money today, you won't be able to buy with it in the future. In short, this is not a scheme to become rich, but a scheme to become poor. People don't easily understand this game of numbers, and that's why bankers, brokers and insurance agents keep making you poorer. If you had invested this same amount in an index fund, meaning in India's economy, you would have received roughly a 15% return. This same amount, over the same time period, would have grown to 95 lakhs. This is why I say these bankers, brokers and investment agents are sitting there to rob and ruin you, because their profit only happens when we are looted. Now let's come to the sell side, meaning the brokers. Most people never manage to enter the stock market at all, but those who gather the courage to enter face a very big problem. When you sign up for a broker's service, they provide you with additional services for free, like trading training, market updates or stock suggestions. In fact, some brokers will provide you with daily calls telling you which share to buy and when to sell. You all accept this happily because who doesn't like free things? But when you read the history of any successful investor who has actually made money from the stock market, you will get only one piece of advice: buy and hold for the long term. As Warren Buffett said, the stock market is a device to transfer money from the impatient to the patient. This means the one who invests patiently for a long time is the one who will make money, while the one who gets caught up in buying and selling will lose their money. But if you start investing patiently, these brokers will go bankrupt because their money is only made when you perform more transactions, and that is why these brokers give you daily alerts and suggestions so that your patience breaks and you make a transaction, allowing them to earn money. Whether you make a profit or a loss, these brokers always stay in profit. When people enter the stock market, these brokers, news channels, articles and YouTube advisors brainwash you and trap you in the cycle of buying and selling. No one tells you the actual secret of earning wealth, and for this reason, people remain trapped in this swamp. Now we come to the third part, how an ordinary person can become rich by using the power of compounding. A question might be in your mind. Suppose we did strong analysis and research, found a company in the stock market and put our money in it. What if the company goes bust? Let me take an extreme scenario for you. Through your strong research and analysis, you invested 100,000 each in 6 companies for 40 years. Your total money invested was 600,000 and the total time period was 40 years. Your stock analysis and research turned out so poorly that 4 out of those 6 companies were ruined and you only had 2 companies survive. Even those 2 didn't give any multi-bagger returns. Instead, they gave a simple 20% annual return. Even then, after 40 years, your investment would be over 30 crore. And if you show a little more patience, say 50 years, your investment will go above 180 crore. If you don't have that much patience and you only invested for 30 years, your amount will still become 4.5 crore. And if your decision turned out slightly better, meaning 3 or 4 out of 6 companies survived, then you would become even richer. No one will tell you this, they will only tell you when to buy and when to sell. So those who have stayed until the end should get some benefit. I will explain one thing to you. If you understand this, you will learn the stock market lesson that people take years to learn. Listen, Rakesh Jhunjhunwala bought Titan shares in 2002 at a value of 3 rupees and today that company's share price is over 3,500 rupees. The most interesting thing is that today in a single day, the price of that share went up by 2.61%, which is 90 rupees. In the short term, even with the world's best trading techniques, if you wanted to grow 3 rupees to 90 rupees, it wouldn't happen even in a whole year. But here, a 29 times return was achieved in just one day. This is the secret of compounding. The one who understands it reaps the benefits, and the one who doesn't understand it pays for it. Your future wealth depends on the decisions you make today. So keep learning, keep investing, and keep growing. If this video gave you value, make sure to like and subscribe. Stay tuned for more valuable content.